I want to talk to you about how to pay yourself as a sole proprietor. In this country, we have millions of entrepreneurs actually file as a sole proprietor. And so here's an overview I want you to pay attention to. So basically, let's first define what a sole proprietorship is, because sometimes people are confused when it comes to the proper definition here. So a sole proprietorship is an unincorporated business one person owns, only one person, okay? It's the simplest form of business you can have. It doesn't require formal paperwork, registration, or legal structure to start. You can simply set up shop and call yourself a sole proprietor, no questions asked. So because a separate business or trade name is not necessary, many sole proprietors operate under their own names for convenience sake. Common examples of sole proprietorships can include many small businesses, such as art studios, freelance writers, IT consultants, or bookkeepers for that matter, okay? And so there are some pros and cons when it comes to sole proprietorships. I want to first walk you through the pros first. When it comes to paying yourself as a sole proprietor, keep in mind that a sole proprietorship, if you will, is very easy to start. There's no need to register or incorporate your business with a state. All you have to do is obtain your business licenses and permits that your state or local government requires. Another advantage is that the sole proprietorship has minimal legal requirements, so sole proprietors don't have to keep a bunch of documentation to maintain their business's legal status. And managing a sole proprietorship is very easy. You have no partners unless you decide to go into business with your spouse. So you basically have a complete say over all business decisions. In addition, because all profits pass through to you, your personal and business, financial, and legal situation are the same. So nothing complicated here, okay? And sole proprietorships taxes are simple. So the owner reports business income and losses on their personal return. You simply need to attach a Schedule C to your 1040 tax return. So you don't have to file a Form 1120S, 1120, or 1065. You only file your Form 1040 and you attach the Schedule C. And what about the cons here? Sole proprietorships face unlimited personal liability. In other words, you can be held personally responsible for your business's debts and obligations. This means creditors can go after your personal assets to get their money. And sole proprietorships taxes are higher. So all sole proprietorships must pay income taxes and self-employment taxes on the total income of the business. So if your business is making a lot of cash, this can be a big chunk of change when you really think about it. And there is more work to do. So as a sole proprietor, you have to take care of marketing, finances, strategy, leadership, and basically every other responsibility. This could create burnout very quickly. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So how do you pay yourself as a sole proprietor? So first of all, you want to set up a separate business bank account where you pay, where you actually draw the cash from. You do this before you pay yourself, okay? Separating your business and personal finances makes financial tasks much easier to manage in the long run. As a sole proprietor, what we have seen in our research is that you basically want to have a clear segregation of work streams, if you will. And you can take money out of your business to pay yourself anytime you want. The profits your company earns is actually your pay, and profit is what's left over from your revenue after subtracting expenses. So there are many ways to get the money from your business bank account to your personal account. So two common ways that we have seen in our research for the last 20 years are to write yourself a check from your business bank account, or to schedule a bank-to-bank transfer known as an ACH transfer. So both options are considered an owner's draw, and it's the way most sole proprietors pay themselves. An owner's draw simply means you'll take money out of your business for personal use. And some sole proprietor payroll doesn't exist. This is because you are your own payroll. In other words, you don't have a middleman involved when you pay yourself, and instead your money goes directly into your bank account and is yours to spend as you see fit. You don't have to draw the same amount each time or do it at regular intervals. When and how much to transfer to yourself is up to you. Most people prefer to make a draw every 2 weeks or once a month. Whichever schedule you choose, keep accurate financial records, and you consider using accounting software to prepare financial statements, which can come in handy at tax time, for instance, okay? And you don't pay income taxes or Social Security and Medicare taxes when you do a draw, though. However, the money is still subject to taxes. A sole proprietor doesn't issue themselves a W-2. Instead, you will file a Form 1040 Schedule C with the IRS when you submit your personal income tax return, as I explained to you a little earlier. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay yourself as a sole proprietor. So when we talk about paying yourself as a sole proprietor, the question, there is another question that is kind of ancillary to this topic is how much should you pay yourself, right? And this is basically one of the most challenging parts of being a sole proprietor. Basically deciding how much you pay yourself from your business. I mean, because when you have a business, you have ups and downs, you have the ebbs and flows, the liquidity ebbs and flows. So you got to really make sure that you have enough cash to actually pay yourself. So it comes down to how much profits your company expects to make and how often you want to take an owner's draw. First, know that you don't have to pay yourself right away. You can leave the funds in your business until you build up a healthy cash flow. Before you pay yourself, make provisions to cover things like regular business expenses. So we're speaking about leases, equipment, fees, inventory, and quarterly estimated tax payments. Cover things like irregular business expenses. So we have renovations, improvements, and expansions. And also you want to make provisions to cover cash reserves. You got to have cash reserves. You never know, right? So if you have the basics covered, you can move to the next step of figuring out how much to pay yourself. So basically you have the bare minimum method. You have the marketplace worth. You have quarterly bonuses. Okay. So you have all kinds of strategies when it comes to paying yourself. So the bare minimum method is precisely what it sounds like. You pay yourself only enough to meet your basic living expenses, such as mortgage payments, grocery bills, utilities, and other necessary costs. Paying yourself just enough to survive with no frills can help your business get off the ground in the beginning. However, it's not recommended for the long haul. Your business should be profitable enough to pay you reasonable compensation. If it is not turning a profit after a few years, consider reassessing your business. What about the marketplace worth? So you can actually choose to pay yourself what you're worth from the beginning or transition into this method after your business grows and stabilizes. Paying yourself what you're worth is often easier in the long run. It keeps business expenses constant, so you don't need to readjust calculations based on a higher owner paycheck. So to figure out your marketplace worth, research what other business owners in your industry earn. You can talk to other small business owners and research your industry online to determine a reasonable amount. Or you can try to really think about quarterly bonuses. Okay, so you may want to pay yourself quarterly bonuses, especially if you're paying yourself the bare minimum. You want to calculate the company's profitability each quarter to ensure it is showing steady profits, then transfer a percentage of the profits to yourself as an owner's draw. How much you choose is up to you. In the beginning, you might choose a lower percentage to leave more money in the business to support cash flow. However, you can increase the amount as your company grows. Totally possible. So when we talk about how to pay yourself as a sole proprietor, there are some tax considerations when paying yourself, right? So taxes are an important piece of the sole proprietor puzzle when you really think about it. Since you don't have an employer, you don't have anyone to take taxes from your payments every time you draw money from the business. You are on your own, really, but you're still responsible for paying them, though. Okay, so I think I told you earlier that the IRS actually is looking at you as a disregarded entity. So basically, a sole proprietorship is a pass-through entity. So the IRS considers you and your business to be the same entity, and all the profits pass through your business and go directly to you. That means you must pay taxes on the profits, not just what you take out as an owner's draw. And as a business owner, you are liable for federal income tax, for state income tax, depending on your state, and also self-employment tax. And so how much you pay in income taxes depends on your tax filing status, income, self-employed deductions, and credits. And when it comes to state income taxes, remember that not all states have an income tax. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and the state of Washington, of course, and Wyoming are tax-free states. New Hampshire and Tennessee has, those two states, they tax for dividends and interest income, but not for earned income. And self-employment tax is a Social Security and Medicare tax that people who work for themselves must pay. And the IRS generally requires that all self-employed individuals, including sole proprietors, to file and pay estimated quarterly taxes if they expect to owe $1,000 or more when filing their annual return. So you want to use Form 1040-ES to figure the estimated tax amounts due each quarter. If you're not really sure, you want to contact an accounting professional for help with sole proprietorship taxes. You can reach out to a CPA, a certified public accountant. You can reach out to an EA, an enrolled agent, or you can reach out to a tax attorney to kind of help out. Again, everything depends on how complicated your taxes are, how complex your taxes are. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay yourself as a sole proprietor. Let me give you a few pro tips here. It's important when you if you want to pay yourself properly, to set up a business bank account. We've already talked about that, but it's not all kinds of, the thing is that you have business bank accounts that are specifically for business operations. What I'm trying to say is that some banks, especially online banks, they have those products where they actually are trying to attract sole proprietors and entrepreneurs of all sorts to sort of have business bank accounts. And what you want to do is you can actually have you can have two business bank accounts. You have one for regular expenses, and you have the other for savings. Okay, in other words, you have a savings account and a checking account. But the cool thing is that it's important to actually have a way to track your owner's draws. So you want to track your owner's draws, how often you draw from your company's cash reserves and how much those draws are. So having a business bank account can really help you sort of track those payments. And so when we talk about paying yourself, it's basically, it can be a transaction, it can be a check, it can be an online transfer, okay? But one thing you need to understand, and going back to what I just said, you need to track transactions, okay? Because that way you'll have a clear idea how much you might owe potentially at the end of the year. Why? Because the IRS actually requires you, mandates that you actually file quarterly taxes if you expect to owe more than $1,000 in taxes at the end of the year. So you want to make quarterly payments so that the IRS is happy and you're happy too. Now, one thing I need to really understand here is that a sole proprietorship is technically not a business, right? So when we talk about having a business bank account, we're not saying that a sole proprietorship is a business, but it really helps to sort of segregate your personal affairs from your business's affairs. If you have a bank account that is totally handling everything on its side, so this will help you big time come tax time. So the thing here is that when we talk about sole proprietorships, you need to understand how sole proprietorships are paying themselves. There is a big difference in how sole proprietors pay themselves and how corporations pay themselves, for instance, okay? Now, how corporations differ from sole proprietors in terms of salary is a pretty interesting, I would say, story. So if your business is not a sole proprietorship but is incorporated, things are a little different. Since you are an officer of your corporation as well as an employee on the payroll, you have to pay yourself a salary or wages, which must be reasonable compensation according to the IRS. Neither too much, neither too little, right? So it's one of those things where the IRS just wants to make sure to actually pay yourself and also contribute to the economy, if you will. Some business owners use the business's money to pay their personal expenses without taking a salary in the belief that this will save them on taxes. But this tactic can backfire and lead to substantial penalties if the IRS decides the money should have been taken as a salary. And if your business is a corporation, basically the best way to go is actually to determine the average rate for CEOs or whatever your title is in your industry, your region, and for companies of similar size. You can get this information from your industry trade association or from sites such as Glassdoor.com or Salary.com. Actually, the BLS, the U.S. Labor Department Bureau of Labor Statistics also has a database, if you will, where they actually have that data also. Keep in mind that salary and compensation can be complicated by factors such as whether your business has investors and how many shares of the business stock you own, right? And so you want to review the IRS guidelines and frequently ask questions about small business owners' salaries and consult with a business accountant before setting your salary. And when we talk about setting your salary, we're speaking about the geography, We're speaking about the liquidity, so the profitability of the business itself, the geography, so which states you're currently living in. So if you live in Newark, Delaware, for instance, the cost of living is not the same thing as if you live in LA, right? So you have some kind of you have a delta, and that delta can be big or small depending upon the geography that we're talking about here. So when we talk about how to pay yourself as a sole proprietor, you got to have a clear idea about how sole proprietors are taxed in the first place. So self-employed individuals must pay income tax and self-employment taxes. So that's Medicare and Social Security when their sole proprietorship's net earnings are $400 or more in the year. Okay, pretty straightforward, not a problem. Sole proprietors use IRS Form 1040 and Schedule C to report income and loss from their business. And the IRS also requires they file Schedule SC to determine the tax due on net earnings from self-employment. And also because draws are not paychecks, as I explained to you a little earlier, no income or self-employment taxes are withheld from them. So it's one of those things where you got to really understand that sole proprietors are responsible for paying all income, Medicare, and Social Security taxes on the business profits. So usually, this is the big usually, and I want you to really make a note of that. Everything is done on a quarterly basis by estimating the amount of profits for the quarter. So when estimating tax obligations, you got to realize that unlike employees' wages and salaries, owners' draws are not tax deductible. And this is why, as I said earlier, you got to really have a specific level of preparation in terms of planning, in terms of budgeting, also in terms of record keeping. That way you have a clear idea what kind of business expenses you have, and what kind of other expenses that you have also. One thing I want to say also is that you need to understand that because a sole proprietorship is very simple to set up, actually you don't have to set up anything because it's very simple to set up and manage. It doesn't mean that it will stay at that level all the time. So in other words, you can start as a sole proprietorship, but if at some point you really feel like you need somebody to kind of help you out, then you'll be forced to have a general partnership. As the name implies, a sole proprietorship cannot have more than one, and a general partnership can have 1,000 or 5,000 members, and the partnership doesn't have to file any paperwork with authorities. It's one of those things where you are basically doing whatever works in your industry. One thing I want to say before closing to this conversation is that please make sure that you are also checking out what the conditions are at the state level, because your state might have different rules when it comes to sole proprietorship taxes, but also sole proprietorship payment. So it's one of those things where you're paying yourself, that's for sure. But do not forget to pay also Uncle Sam. Very important. Thank you so much for your attention. I really appreciate it. In today's conversation, I just explained to you how to pay yourself as a sole proprietor. So let me quickly give you a recap here. So I gave you the overview, the pro tips, and now the extras. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.